The standard playbook for building wealth in the stock market has barely changed in 40 years. You buy a passive index fund like the S&P 500 or the Nasdaq, you hold it, and you let the crushing momentum of the broader market do the heavy lifting for you. Trying to actively trade your way past that benchmark over a timeline of 10 or 20 years is notoriously difficult. Most human fund managers, despite their vast resources, consistently fall short of the market average. When a quantitative strategy claims to nearly double that average, you have to look closely. This chart plots an open-source breakout strategy against the S&P 500. From 2006 to 2026, the index returned 11.8% annually. The algorithm claims 22.3%. Applied to the Nasdaq 100, outperformance is higher, clocking a 26.6% return against the benchmark's 17.3%. In quantitative finance, exceptional historical paper returns are an immediate red flag. They often mask over-optimized code or testing environments that fail to reflect the friction of actual trading. To figure out if this mathematical edge is real, we need to completely deconstruct the rules driving these trades and critically examine the exact laboratory where those numbers were generated. Every algorithmic trading system starts with its entry logic. This is the engine of the strategy, dictating precisely when capital is deployed into the market. This particular strategy relies on an EMA momentum stack. This candlestick chart demonstrates the exact setup. We have a 21-day, a 50-day, and a 100-day exponential moving average. The system will not initiate a trade unless all three lines organize themselves into parallel, upward-sloping trajectories. Once that mathematical alignment is confirmed, the code waits for the asset price to cross above a rolling 6-month high. But a price jump isn't enough on its own. The algorithm requires a secondary confirmation in the form of a sharp spike in relative trading volume, ensuring institutional capital is actually driving the move. By stacking these highly specific criteria, the system strips out the temptation to predict market bottoms. It forces the trader to only commit capital to established, high-momentum trends that are already proving their strength. Generating outsized returns requires aggressively killing bad trades before they drain the portfolio. If the entry logic is the engine, the exit protocols are the brakes. To prevent deep drawdowns, the algorithm employs a strict trailing stop. The code automatically sets a floor exactly 24 to 25% below the asset's highest recent peak. The moment the price action drops, intercepting that floor, the position is liquidated entirely. Furthermore, the system artificially restricts its own exposure. The trader is capped at holding only 2 or 3 simultaneous positions, and the entire portfolio is forced through a mandatory rebalance every single quarter. Breakout trading is inherently volatile, but by pairing highly selective entries with strict exit constraints and limited sizing, the strategy creates an asymmetrical risk model where losses are capped and winners are given room to run. Having established the rules of the code, we have to look at the methodology used to validate them over a 20-year timeline. A major trap in quantitative testing is look-ahead bias, tuning your parameters to perfectly fit past data. To combat this, the developers deployed a sliding window backtest. Look at this 20-year timeline. Instead of running one continuous simulation, the system processes the data in 11 overlapping 10-year blocks. It calculates a performance metric for 2006 to 2016, then shifts forward exactly 1 year to 2007 to 2017, generating a fresh metric with every step. This overlapping method prevents the code from optimizing for a specific economic era. The algorithm is forced to navigate drastically different market regimes independently, from major macroeconomic crashes to periods of runaway market growth. Surviving an 11-window sliding test provides a more scientific proof of edge than a single static 20-year historical simulation. But even with rigorous overlapping tests, this simulation houses a severe structural flaw, and it lies entirely in the data. The blind spot here is a statistical phenomenon known as survivorship bias, specifically regarding how index composition data is sourced. To evaluate its performance against the benchmark, this simulation relies entirely on the modern lists of companies currently sitting in the S&P 500 and Nasdaq 100. Because it uses the current index roster, the historical data accidentally filters out the ghosts.
Over the past 2 decades, dozens of companies have gone bankrupt, merged, or been delisted, completely vanishing from the available dataset. The algorithm is mathematically evaluating only the companies we already know survive to the present day. Because it never had to risk capital on the failures of the past, that 22%